Is it a certain percentage of the tenant's rent income that is used in the investor borrower's qualification income?
Absolutely. So conventional full doc mortgages, they are going to receive in the acquisition year formula, because there's two formulas that will be used in underwriting. One is called the acquisition year. The other one is called the Schedule E. I'll focus on the acquisition year. This is applicable from the date that they acquire the property and until that tax year's federal tax return is filed. They get up to, I need to define up to in a minute, they get up to 75% of the gross rents minus the proposed PITI, principal, interest, tax, and insurance. Now I say up to because it depends on two primary criteria that the borrower must possess in order to get the full 75%. So think about it this way, there's three buckets. Okay, the first bucket gets the full 75% of whatever the gross rents are. The easy math example that I give, let's say that the gross rents are $1,000 a month,
Okay.
and the PITI proposed payment is $500 a month. If they're in bucket number one and they get the full 75% of $1,000, they have $750, right? And from that, they're going to subtract out the $500 of mortgage payment. In that example, it would leave them with a gain, a positive $250, right? So that individual came to us with a debt to income ratio of X. As a result of purchasing this investment property, their DTI is going to go down because they're $250 richer, right? Monthly. So 75% is the maximum you can use in the acquisition year. That individual in that bucket has to demonstrate two things. One, they have a primary housing expense, whether that's a mortgage or they rent, either is fine. And then second, they need to be able to demonstrate that they've had 12 months of history in owning investment property.